good afternoon. So today we will learn a new topic, which is capital budgeting and investment appraisal.
I have a question. So what is capital budgeting and investment appraisal?
Good question, Aini. So everyone, please open up your case study assignment for February 2025.
First of all, let's take a look at investment appraisal. Investment appraisal, also known as capital budgeting, it is a critical strategic process where SMEs evaluate potential major expenditures to ensure financial viability. This involves calculating the potential return on investment, which is ROI, for specific opportunities such as purchasing new machine, introducing new product, or building new facilities. By conducting a comprehensive capital budgeting that accounts for market conditions, competition, and inherent risks, businesses can make informed decisions on how to best allocate their limited resources for maximum growth or profit.
So, for the initial outlay, the cash outflows include the purchase of the new machine at 110,000 ringgit, transportation cost of 10,000 ringgit, and installation cost of 30,000 ringgit, giving a total new asset cost of 150,000 ringgit. There is also decrease in current liability of 20,000 ringgit, which is treated as an additional cash outflow. Next, the cash inflows consist of a decrease in current asset of 25,000 ringgit and the sale of the old machine for 31,000 ringgit. Since the old machine is sold at a loss of 9,000 ringgit, a tax saving of 2,160 ringgit arise. After offsetting the inflows against the outflows, the initial outlay is 111,840 ringgit. In the workings, the new machine is depreciated at 8,000 ringgit per year, while the old machine has a loss on disposal of 9,000 ringgit, which explains the tax benefits. Let's conclude the explanation of the initial outlay.
Moving on to annual differential cash flow. Differential cash flow show how much extra cash the project generates. The project increased revenue by 28,000 and reduced expenses by 8,800. However, depreciation is increased by 6,000, which affect profit but not actual cash. After tax at 24%, the net income is 24,060. Since depreciation is a non-cash expenses, it is add back. So the differential cash flow is 30,060.
Next is terminal cash flow, which happened at the end of the project. The company received 80,000 from the asset salvage value, minus 20,000 from a decrease in current liabilities, but plus 25,000 due to a decrease in current asset. This results in a terminal cash flow of 85,000.
First, we are going to analyze the payback period. For the payback period, we divide the initial investment by the annual cash flow. The initial investment is slightly above 111,000 ringgit, while the annual cash flow is slightly above 30,000 ringgit. Therefore, the payback period is approximately less than 4 years. This means the company can recover its investment in a period of about 3 to 4 years, which is shorter than the targeted period. For NPV, we calculate the present value of all cash inflows and subtract the initial investment. After discounting the cash flow at 10%, the total present value is 54,721 and 15 cent ringgit. Since the NPV is positive, it means the project generates more value than it is cost. Therefore, the investment is acceptable. Now, to calculate the IRR, we use interpolation because the NPV changes from positive at 10% to negative at 24%. By applying the formula, the IRR is 23.89%. Since the IRR is higher than the cost of capital, the investment is financially attractive. In conclusion, the project should be accepted because the payback period is shorter than the targeted period. The NPV is positive and the IRR is higher than the cost of capital. Therefore, the company should replace the old machine as it is profitable and beneficial in the long run.
This presentation is based on two key articles, Financial Management Strategy for SME and the Importance and Role of SME. This article highlights the critical role of small and medium enterprise in economic development and the financial challenge they face. Small and medium enterprise, commonly known as SME, are often referred to as the backbone of economy. According to the article on the importance and role of SME, this business play a significant role in job creation, innovation, and economic growth. In many countries, SMEs account for more than 99% of all business, making them essential to economic stability and sustainability. SME are generally defined based on employee count, economic contribution, and financial challenge. Typically, an SME employs between 10 and 100 employees, although this may vary by country. From an economic perspective, SME's contribution significantly to a nation's gross domestic product, especially through local business activity and supply chains. In terms of classification, SME can be divided into two main types, traditional SME and modern SME. Traditional SME are usually smaller in scale, rely on conventional business method and focus mainly on local market. In contrast, modern SME adopt technology and innovation to improve efficiency, expand their market reach, and support business growth. However, as discussed in the article Financial Management Strategy for SME, many SME face serious financial challenges. These include limited access to capital, reliance on information financing, and low level of financial literacy. Without proper financial planning, budgeting, and cash flow management, these challenges can limit business growth. The article emphasizes that effective financial management strategies are essential for SME sustainability. Strong financial practice help SME manage risk, improve performance, and achieve long-term success.
Now that we understand SMEs, let's explore one of their major challenges, which is financial management. For SMEs, managing finances is not just a task, but it is essential for survival. Many SMEs struggle to obtain funding because banks often consider them high risk. As a result, they rely on personal savings or informal loans, which can limit business growth and innovation. Firstly, cash flow management. SMEs operate with limited resources, so managing cash flow is critical. Late payment or unexpected expenses can disrupt operation and create financial pressure. Second, financial literacy. Many SME owners lack formal even financial knowledge. Without strong understanding of budgeting and financial planning, they may make poor decisions that affect business sustainability. Another key issue for SME is innovation. Innovation is not optional, but it is necessary for survival and competitiveness. New product development. SMEs are flexible and able to develop new products quickly to meet the changing market demand. Second, technological adoption, which is technology helps SMEs improve efficiency and reduce costs. However, high costs often prevent them from adopting modern systems. Lastly, market adaptability, which is SMEs can adapt quickly to market changes. This kind of ability allows them to stay relevant and seize the new opportunities. The next issue is risk management, which is hard for stability of SMEs. First, financial risk, which is SMEs are vulnerable to economic changes such as inflation and interest rate fluctuation due to limited financial resources. Second, operational risk, which is dependence on limited customer or resources can expose SMEs to significant operational challenges. Last, insurance coverage. Like so many SMEs lack adequate insurance due to cost or low awareness, leaving them exposed to unexpected losses. And finally, strategic decision making determines the future direction of SMEs. Investment appraisal, like SMEs must carefully evaluate investment opportunities to ensure effectiveness use of limited capital, and also for the budgeting practices, they must have proper budgeting helps SMEs to control costs and align resources with business goals. Lastly, stakeholders' impact that considering the needs of employees, customer, and suppliers leads to better decision and long-term success.
For investment appraisal process for SME, for our case study, there is 4 process to determine the investment appraisal. The first one is identify project. Zenlife Sdn Bhd is considering replacing its 5 years old production machine to enhance its efficiency and reduce the cost. After that is to estimate relevant cash flow. There is initial outlay, annual cash flow, and terminal cash flow. Next is decision-making technique. We use net present value, payback period, and internal rate of return, which is IRR. And lastly is making decision, which is to compare results with the company desired target and capital costs. And lastly, let's take a look at the decision making to determine the investment appraisal for our case study. There is 3 decision making that we use to determine the investment appraisal for this. First one is net present value. The project shows a positive net present value by replacing the old machine. It adds value to the company and improves its long-term financial performance. After that is payback period. The payback period for the project is 3.73 years, which is shorter than the targeted payback period, which is 4 years. Therefore, Zenlife Sdn Bhd can accept the project. And lastly is internal rate of return, which is IRR. The internal rate of return for the project is 23.89%, which exceeds the target rate of 10%. Therefore, the project is acceptable under the IRR criteria.
In conclusion, investment appraisal is essential for SMEs, allowing them to evaluate significant expenditures and ensure financial viability. By analyzing options like purchasing new machinery, businesses can make informed decisions that align with their growth objectives. In this analysis, the positive net present value (NPV) and favorable payback period confirm that investing in a new machine is financially prudent. The IRR of 23.89% exceeds the cost of capital, indicating substantial potential returns and quick recovery of initial costs. Applying investment appraisal techniques is vital for SMEs to navigate financial challenges. It fosters informed decision-making and optimized resource allocation, ensuring investment yield in the highest returns. This process ultimately enhances efficiency and supports long-term sustainability in a competitive market.